Okay, everyone here at the Investing Stuff You Should Know podcast. Good morning, good afternoon, good evening, wherever you are right now. We have an exciting guest with us today. We have Chris. Chris and I met, I think, at the Best Ever Conference in
Yeah.
Denver last year. Hey,
Yep.
Chris. And we were so excited to have all these diverse backgrounds. We have bankers, we have people setting up funds. We have Chris's particular situation. He was a general contractor, and he has a amazing, successful, syndication and capital raising and multifamily business right now. So, Chris, welcome, and you can just introduce yourself and let the people know where you are residing, where you invest, and kind of where you came from. Just a little bit there.
Yeah. So my name's Chris Stout. Nice to meet everyone. I currently live in New York. I'm sorry. I currently live in Jersey. I have to get used to this. I currently live in Jersey. I am from New York. I just moved. It's just a couple of months old, so I'm still getting used to it. We invest mainly in the Southeast, obviously. So we have a ton of stuff in New York still, which I'm not very happy about. All the syndication and everything that we get investors involved with is in the Southeast. We're currently exiting everything we have in New York, slowly but surely exiting everything we have in New York. Most of the holdings are in North Carolina and Northern Alabama, and actively purchasing a 146 unit deal in Fayetteville, North Carolina. The third of 3 deals we've purchased from the same family.
Awesome, man. Yeah, it's amazing to develop a relationship and actually have things go well and really do these large transactions that impact a lot of people as wealth, trades hands and moves, and wealth has life cycles and areas it needs to be sitting in as families and we all change and age and families grow up and all these different things. It's a very natural life cycle, and it's wonderful to see that happening. I know it's kind of a high level comment, and we can talk about that later. But anyway, so let's go back again to, I guess, college, Chris. So he's in New York. He goes to college, and somehow, which we had a little pre-chat, what just kind of give us a little bit there. Why did you know real estate was in your DNA? How did you know that?
So that's a funny question, because when anyone gets started, I know a lot of people who get started in real estate. They're like, what's all this money that everyone's talking about? I don't see it. So I know a first real estate transaction, my first purchase. I could tell you the cash return monthly was about $600. So I was going to invest $125,000 to buy this 2-family house that I bought for just under $400,000. I was going to do all this work to it, which at the time I did all the work with my own 2 hands, did all this work to it, rent it out, deal with the tenants, and I'm going to make $600. So I'm basically going to, over the course of 30 days, I'm going to call it at the time what I would earn in 2 days working with my hands on, doing renovation projects or construction projects for others at the time. And I kept knowing that real estate was the vehicle to long-term wealth. So don't look at what you're making today. Make sure that you're looking years and years and years down the road. And I think the problem with a lot of people is, especially young people, is a 22-year-old never thinks he's going to be 32. Never. It's never going to happen. Or 30.
That thought doesn't cross his mind. Like that's not me. Like no, that doesn't exist for me.
Yeah, never. It will never exist. And when it does exist, it's going to be so far down the road, and something else will turn for me by then. And then you're 32 and you're like, oh, I should have bought that deal. So, especially in the high growth markets and other markets that we work with, the appreciation happens much quicker than you think. If you're trying to watch paint dry, it doesn't happen. But if you just close your eyes for a little bit and then you look back, you're like, whoa, good thing I bought that deal. So, the stories, I constantly hear of stories of, I can't believe, you realize what my parents paid for this house? Or, we just sold, just about 1.5 years ago, we sold my mother's house. So we have to go through, she owned the house for 30 years. We still have to go through the paperwork of what she paid for it to figure out the basis over the period of time she owned it. She paid $30,000 for the house and sold it for $400,000. So, and then you're like, oh, wow, imagine if I bought that house, 30 years ago, which, obviously we're trying to make money much faster than that. But, it's always a very interesting thing when you look far down the road. You realize that you will get older, time will pass you. You will one day be in your 30s, or you will one day be in your 40s. Don't think if you're in your 30s, you can't start. Don't think if you're in your 40s, you can't start.
Yes.
40, I can tell you I'm 39 now. The idea of me being 50 is probably the same as if I was 21 thinking I'm going to be 30. So for me, like the idea of being 50 is way down the road, but I know all I have to do is keep accumulating. No matter what I do, that time is coming. Hopefully that time comes. And I'm going to be all right. So the answer to your question is the long-term vision I was able to generate at a young age. And I don't know why that happened. I don't know why I was told, or my brain told me to think that way, but I know when I was younger, I was always put into the category of Chris is like the older of the 20-year-olds mentally. So, that's just, I guess that's just something I was blessed with at the time. But the idea of looking very far down the road would be, why I got into it.
Awesome, man. So that's, so that was, I guess that maybe to summarize that, it was just kind of there. You saw it, elements of it. I mean, obviously we grew up, we see different things around us. And so, it's not that unusual for many of us to see that there's something there that we want to be part of. Yeah. So then right out of college, you started, you like, how can I get into this right away? And you started kind of helping other people. I want to be in real estate. And then, so like the quickest way for me to get somehow be an adjacent space or in the space is start helping other people fix their homes, bathrooms, cabinets, kitchens, doors, all that kind of stuff. And then probably with a view, again, is that true that you didn't really know even where that might go, but like just as long as you're kind of taking a step in that direction?
Yeah. So I'm good at spreadsheets and mechanics. So when I was very young, when I was still living at home, I ran a little car repair business. Out of my parents' house, out of my mother's house. And so that always worked in my head. And then as time went on, I was like, all right, I'm going to start working on houses. So it was very mechanical. And then as that business went on, I always wanted to grow that into being a home builder, build houses, invest in real estate, build houses, invest in real estate. So, just constantly growing in that direction. Building houses is a very capital intensive business. And I knew building one house at a time by struggling with your own capital is not a very scalable thing. By the time
I learned that too, Max, by the way.
Yeah. Like, what are we doing? So, for me, making whatever amount of money is cool at first. So call it, I built a house, made 100 grand, built a house, made 100 grand. This is cool. But what do we do now? This isn't going to be cool forever. So how do we make it build 2 houses, make 200, build 4 houses, make, so then it goes build 4 houses, make 300. How do we do that? Build 8 houses, make 600. Okay. So we could scale by bringing others in that aren't interested in building houses, but are interested in making money. So now combining all these people together is kind of where all the magic starts to happen for us. So just bringing individuals in to invest, leveraging relationships that we've built by working on people's houses, which if anyone listening or when you work on someone's house, you're really figuring out who that person is.
Oh yeah, so, it's difficult not to. I mean, it's very not in a gross sense, but it's a very intimate relationship. I mean, you're in their house, you see everything, they see you like for hours at a time, and your phone calls and you taking lunch and all these things. It's, I mean, like it's 2 people. You're right in there.
Yeah, you're in it.
Possible not to know.
Yeah, by the end, you either built a relationship or ruined one. Yeah. So just leverage those.
That's actually really good. That's a really good point, Chris, actually.
Yeah. So leverage those relationships into people who are interested in investing in my future, but with also making money, which their investments led to investments into home building, which allowed me to grow my home building business and allowed them to earn a return on the money. And then was one investor, I think his name was Vic, who's actually still a current investor in my multifamily stuff.
Ah, nice.
Said, hey, this is great, but I'm not really interested in the short-term stuff as much as I thought I would be. Because
now, so for the audience now, so now we're segueing or kind of growing. Watch this. So Chris was in college, and then in the New York area, upper New York area, and then we went to some kind of real simple fixing, and then kind of, a little more, probably larger projects, the project scale. He got a construction company. Now he started getting some feedback from some of his people that he's working with that are maybe just kind of like hard money or just personal loans. And that's how a lot of his kind of grow there. And he starts getting the word on the streets, like, hey, I need something a little bit longer, a little bit bigger. So this is a lot of people have done this and have seen this, and it's very, very powerful. But anyways, that's kind of the stage that Chris is at. So please continue.
Yeah. So leverage your relationships, pushed it into new construction. Then we get hey, these returns are great, but I guess what starts to happen is people realize that 12 months comes around very quick. So, you invest into a deal and you're out in 12 months and then you have a return. Great. But what do I do now? And with development, it's kind of, well, there's nothing right now, or we're working on a new project, but we don't need capital for it yet.
Right.
We're waiting on approvals, or, the million things that we have to do for development. So the investors are like, hey, we need something a little bit longer term. We know that you take the profits from what's left over for you and you buy apartments with it. How about you put it in that? And so my initial reaction was absolutely not. I'm not interested. You stay in the new construction side, and the apartment stuff and the long-term investing is for myself and my family. And I went home that night. I was like, ooh, I think that was a mistake. Let me look further into this. So then it put me into the position of researching and understanding how the whole real estate syndication business works.
Yeah.
And realizing that there's an entire business based on this model of bringing people into apartments, just buying larger stuff, scaling quicker. The exact same thing I was trying to do in the new construction thing, a whole business that I wasn't even aware of that people did this.
Oh, amazing. Wow.
Yeah. And it's kind of like you step back and you're like, as a small, having a little bit smaller of a mindset. So I lived in New York City at the time. Like, who owns all these buildings? You don't really put it together that it's not an individual, it's groups. Groups of people, there's the one guy who owns the whole thing, but for the most part, it's all groups. And you're like, oh, groups. Real estate's a team sport. It's all starting to make sense now. Okay, investors, you were right. Let's jump in the apartments.
I'll share a piece of ignorance. Like, I didn't even think about that anybody owned them. Like go downtown. Wow, amazing buildings. It's like somehow they're just there. I mean, just stupid me, but I wasn't even at the point where you thought like a single person owned them.
You know what? I could tell you that immediately before that thought, I didn't put together that someone owned them.
Yeah,
they just existed.
They're just there, like this.
You didn't realize there was any ownership behind it. Yeah,
pillars of wealth and creation and utility and beauty were just somehow they just kind of came into being, and they were just magnificent and just sat there.
I could tell you, even at my stage now, if I put some real thought into Manhattan, the idea that all that was ideas that accumulated over a long period of time, these tremendous, magnificent sized deals came together all at one time to put these ginormous structures together in this wonderful city. Like, the whole mindset behind the whole thing, you start to really put together, is truly like an amazing thing. I could tell you, as time goes on, even coming from the area, I appreciate Manhattan more and more every year that I get older.
That's good insight, Chris. Yeah, the fact, though, I think perhaps part of the growth is your realization of the kind of, like you said, the legacy, the value created, the wealth created, and that type of thinking. Like, that kind of thinking is like the thinking that King Solomon had to build the temple, and also maybe back in Europe when they built the cathedrals, like this massive, like this long-term thinking for a lot of many people. So that's the kind of thinking that these people adopted, that so many of us are just like middle class, we do our thing, we own a home. But this is like a next level, next couple levels of thinking why these things came into existence.
Yeah. I mean, there'll probably be a hard, with the exception of few innovators who would be, a Musk, the richest guy in the world. There's few people who will ever hit their peak of potential thinking, of putting ideas together. The idea that the human brain and human body are literally capable of almost anything you throw at it. It's such when you start to actually sit down and think, get out of the whole realm of like show up to work 9 to 5, go home, do nothing. Like, once you start getting out of that realm and you start bigger thinking, like what, now the limit for all of us is not not what it's we can't even think of what to think of. Like the just know that the
human brain
realm
doesn't
of how far you could go is
the human brain doesn't
endless.
deal with the infinite very well. Like it's not
Right.
really there's nothing intuitive about the infinite, which is
Yeah.
why even to be creative, you have to actually have some confines. But yeah, so I mean that part of your point is like because of the limitless potential. When if I was to yell at you like Chris, think of something incredible right now, I'd be like,
Yeah. Yeah. Yeah.
So anyway, so
Yeah.
that was an awesome tangent actually. But anyway, so pivoting back to
Yeah. Yeah.
our
Yeah.
story. So this like you said, you graduated through the construction space and new development. And we both know that new development, actually I'll turn that into a question.
Yeah.
What is the kind of the having been in it, what is the kind of the normal trajectory? So it's kind of almost a boom and bust cycle, is it not, Chris?
With the development.
Yes.
So I could tell you, all right. So okay. So we talk, you heard me in the beginning of this podcast talk negatively about New York. Specifically, what I'm referring to is the landlord tenant laws are very difficult to deal with, extremely difficult to deal with. Not to go too deep into it, but the laws are set up that they will literally bankrupt a landlord with no care at all for someone who's intentionally not paying their rent. Okay. So this is why we wouldn't put investor capital into deals in New York, because we are unable to control it. Too many things outside of our control are able to happen to change the metric of a deal.
Yeah. Is that New York City like proper, or is that like New York State? I mean, I'm sure there's bleed through of the laws, but is that
yes,
just to define that?
New York State is bad. New York City is worse.
Okay.
So you can't leave the city and get into good territory. New York as a whole is bad.
Yeah.
So, in the Southeast, our deals we have tremendous control over our deals. The property managers are superb. And if anything happens outside of our control, it's typically covered by insurance. So we're not being limited by the government to run our business, and we're not being really told what to do. So if something were to happen outside of our control, which is usually some kind of natural disaster or event, is covered by insurance. So we're very well protected in the states that are more landlord friendly. So, but New York is a very stable real estate market, extremely stable real estate market, because I know I learned this a long time ago in real estate, and I don't know if you could see my hands if people are watching this, but when real estate is bound by barriers and cannot expand outward, it could only go upward. So whether you have land barriers, water barriers, land barriers such as mountains, where you physically cannot build any further, New York City is that. You cannot make it any bigger. New York City is mostly islands. The real estate could only go up. So where we put ourselves in a position where even 2008, if you were building through 2008, as long as, and this holds true for any real estate market, and especially true for developers, a little bit less important for apartment investors, but still important. Don't be overly speculative about your investing. So don't put yourself in a position where you're like, oh, it's grown 10% this year. It's grown 15% this year. It will continue this for a long period of time. Do not do that.
Yes.
As long as when you in a development play, in a real safe market, you say, by the time this is done, I will sell it for what it's worth today, you're in a much better spot. So building in New York, we're in a very stable position where it's a
different approach. And like, you can't don't obviously throughout the emotion, assume, I guess the best you can assume is like the normal, rather steady eddy growth, consistent growth. Like you said, safe means low return. Typically, the safer it is. I mean, that's there's nuances there, but the lower it is. So plan for, I guess you have to find the upside in other methods, by operation, execution, incredible teams, supply chain, and things like that.
Yeah. So I mean, New York being incredibly stable, if any market fluctuations are okay. So I know there are a lot of countries where you have unlimited building potential, areas of Texas, areas of Tennessee, where just areas of some parts of the Carolinas where you could just build forever and never run out of land. There's definitely boom and bust in that industry. Tremendous. And usually you're building much higher volume. You're building tracts of hundreds of houses.
Yeah.
Where you're working on a street. Usually, in New York, we work on relatively higher margin.
Okay.
because the land is limited.
Yeah.
So we could build fewer houses and say make numbers a couple 100,000 a house, which sounds crazy to some guys in the South who are making
Yeah.
$20,000-$30,000 a house, but they're building so much higher volume that their gross income would be larger, but it's spread out over a much larger risk base,
Yeah.
right?
And also another piece, of course, I know it's so probably people are nauseated of hearing it. Again, that supply chain, like these are some of the fundamentals of supply, supply and demand. So yes, if you can do, like, if the barrier to entry is low and anybody can just go to the next field and put another 50 homes or 100 homes, versus, like you said, in New York at the beginning of this little segment, is like, hey, we're waterlocked here. There's not, you can't just keep going out. So yeah, there's that's some very basic fundamentals for people to keep in mind on that.
Yeah, and be careful. Like, so we see these, and now it sounds like I'm on New York's team, but you'll watch like the U-Haul reports and the trajectory of where the people are headed in this country. I could tell you just firsthand experience that they're talking about everyone leaving New York City. It's getting backfilled with new people. I mean, I know people that live in Manhattan, they can't get an apartment. If there is an apartment open for lease, there's a line down the block. It's Manhattan is full. New York City is full. It's tough to break that, even with COVID, how it was. New York City did go through a very tough time. Just people didn't want to be so close to one another. And
what do you think what do you think that is, Chris? What do you think that is? That like there's certain markets, and we just kind of shrug our shoulders and say, like, it's the world financial ecosystem, or Chicago is like the natural hub of the U.S. with all this rail and water and transportation, and maybe those things are the explanation. What's your take on that? Why is New York gonna, like, just perennial here? Just you can't seem to kill it.
Kind of loops back to what I said, is as I get older every year, I appreciate Manhattan more and more. New York City, center of New York City, more and more. You cannot duplicate the infrastructure of New York City. So first of all, no city matches its size, its sheer size. And I know a couple of years ago, I passed through Times Square 2 hours after the ball dropped. So Times Square, I don't know how many people are there, but it's a lot. 2 hours after, it looked like no one was there. Everyone was gone and the streets were clean already. So the power of New York City to move people, physically move people, I think is one of the amazing things of it. Just being able to do everything you want within such close,
such a high density
proximity.
High density of population in a tight area, and then their efficiency, their operational and economic efficiencies that they have there. So that's good. That's an awesome answer.
I honestly think smaller emerging cities throughout the country, as time goes on and we need less and less office space, if that winds up happening. So we're talking about, like, and I know we have some time behind it, but the AI, I know, is starting to kick in, right? The metaverse was like, we dipped our toe in it quickly. And, listen, we're on a Zoom call with mediocre video quality. We're headed in a direction that this will get just continuously better and better and better. If you don't think it will, you should change your mindset. These Zoom calls and this audio and everything will just continually get realer and realer and realer, where we're like, okay, maybe this meeting that we're having now on the Zoom call is great. Would it be better in person? Probably. Yes. So the gap will continually get closed, that we will almost, I believe, get to the point, maybe in our lifetime, maybe not, get to the point where it will be difficult to determine the difference between reality and virtual reality.
Yeah.
But as that time gets closer, I believe that New York City, LA, these cities, LA, probably New York City, LA, and Miami will always be backfilled by the smaller emerging cities emptying out. So as if an office in New York City empties out, it will be backfilled by a smaller emerging city office person who wants to be in New York City, and it will slowly vacate these, like I said, these smaller cities that are, like, call it, like, I don't have an example for you off the top of my head, but basically smaller emerging cities will always backfill those three cities.
Interesting. All right, folks, you got some predictions from Chris Stout here on some, this is like long term, he's probably maybe 10, 20, 30 years away here, and kind of
Yeah.
this emerging, perhaps an emerging trend. But I fully agree on the part with the technology piece, when we have the ideal, at least ideal to most, is like maybe in person. And then we have what we have now with this 2D screen, which is even better than it was like a couple of years ago, at least the ubiquity of it. And now we have, like you said, we have something closer to some type of hybrid mix of virtual and augmented and real reality, and that's becomes, it's like you said, in closer closer and closer to indistinguishable between us having a cup of coffee at Starbucks. All right, man. So let's kind of come down to the last segment here of the. So now you're in, I think, and correct me if I'm wrong, full time. Would you call yourself a capital raiser? Is it a fund? What did you call your current, I guess, version of your company, and where you guys are going?
Yeah, so I'm a general partner. I'm the operator of the deal. So I find the deals, put them together, purchase them, and then being part of that, also being a capital raiser. So I don't raise I don't raise capital for other people's deals. When I'm raising capital, it's for our own deals. So naturally, anyone in my seat who's putting together deals and actually closing on them has the title capital raiser somewhere in there. So I do have staff below me that takes care of the smaller items. But it's essentially me checking off the deal, signing on the loan, putting the deals together, bringing everyone together, putting investors into deals. It's full-time apartment syndication. It's apartment syndication 101. It's as solid as it gets. And that's basically, that's what we're doing. So, buying apartments and making money.
Awesome, man. What do you think there's this is not to not taking anything away from your team. Do you think there's something
Yeah.
unique that the Chris Stout team, you and the team, do that's maybe different or beneficial? Have unique insight or any special philosophy that sets you apart? Because when you get into the space, we know there's lots of syndicators out there,
Yeah.
and but also they all have their unique. They all have a thumbprint of the core team as well. What do you think? I'll turn that. That's a better question. What do you think your team is?
I could tell you that the guys at the top are all probably very equivalent. So the people who are really doing this business right, there wouldn't be a tremendous difference between the guys who are all doing it right. So what I like to do is I like to separate myself from everyone who's not doing it right. You'll see some general partnership teams that there's 10 people on the team and who's doing what. There's a bunch of people who aren't pulling their weight. So I put ourselves in the class of apartment syndicators who are actually really doing solid deals that are unmatched. So we build relationships, we put together strong deals. Our deals are underwritten and financially stress tested to the absolute max. I have no emotion in this business. I do not buy something because I quote unquote like it or I quote
Yes.
unquote want it.
Yeah.
I have no emotion, zero emotion on deals. If the deal does not work, I want a divorce. I don't want to see you anymore. So we only sign our names on deals that are just truly spectacular, and we put relationships. We really leverage relationships. Like I've worked on my whole career, it's all leveraging relationships, whether it be raising capital or putting together great deals, just merging all that together. And putting together just class A deals that are going to earn the investors super strong returns, and operating the office as such. I mean, the investor relations team is awesome. We're underwriting probably 200 deals compared to other syndicators who might be underwriting 50 to 100 to strike a deal. We just keep going and we keep pushing to make sure that we get the absolute best deals on the contract.
Amazing, man. And I like the nine height part of that, where it's not like, oh my God, we do this. I mean, like, yes, we're doing all these solid things, but just like that, just the really kind of straight line comparison, like, we're like out there with the best, doing it right. And just like if you go to Wall Street, there's a lot of awesome companies that are very well run, and they're providing good returns. And we know this real estate investing is an alternative asset class for investment. And you want to know the people that are doing strong teams, they're doing it right, that are performing year after year after year. So that's I love that.
Yeah.
What's the best way for folks to get to know you better, or anything you want to share, of course. And then how can they reach out?
Yeah, that's great. So the website is stoutcap.com, STOUTCAP, stoutcap.com. And my most active social media platform is Stout Build on Instagram, STOUTBUILD, Stout Build on Instagram. We're spread out on amongst a bunch of socials, but the most active that I'm personally on is Instagram.
An Instagram guy. Okay. All right.
Yep.
I'm a LinkedIn guy, but Chris
Yep.
is we won't hold it against him here. But anyway, we met on this we met for the podcast. So
we linked up on LinkedIn.
Yeah.
So LinkedIn would be number 2 for me, and Facebook
Awesome.
is like all the way down the road.
Yeah. It's like, oh, whatever.
Yeah.
Okay. Okay. Well, thank you everyone at the Investing Stuff You Should Know podcast for listening all the way through to another episode. We would request a like, a comment, share it with your friends if you like this kind of content and the kind of guests that we bring on and the kind of knowledge that we share. So until next time, Chris, thank you, and everyone else signing off.